Isn't war supposed to be good for gold and silver? Why didn't people buy gold and silver? After all, oil soared on the week, up about 35%. We closed around $91 a barrel. That, I think, is the main reason that gold and silver sold off. I think it was a buy the rumor, sell the fact. There was some speculative buying in gold and silver. We could be at $6,000 gold, and silver could be back above $100 an ounce very quickly, as oil prices are going to be over $100 a barrel. We sold on the actual war. The traders took profits, and gold and silver went down. And the reason the war is bullish for gold is not because of the war itself, but because of the way we pay for it. The way we're going to pay for this war is by creating more inflation. And that's what's bullish for gold. We are going to run bigger deficits because of the war. Now, we were going to run bigger deficits anyway because of the weakness in the economy. Donald Trump has already made it clear, not only are we going to pay for this war, probably in excess of $1 trillion to destroy and rebuild Iran. Let me go back and talk about what happened during the week, because precious metals, gold and silver, and the mining stocks, actually, were the biggest losers on the week. Gold finished the week down about 3%, and silver was down, about 5%, 5.5%, something like that. They closed out the week on a positive note. Gold was up almost $90. Looks like it closed around $51.70. So still comfortably above 5,000. In fact, with all the selling that happened earlier in the week, gold never even got below 5,000. So there is a lot of support there, which is what I've been telling everybody. Silver closed up over $2 on the day and still ended the week above 84. Looks like about 84.33. So these are still good prices. They're much higher than we ended last year and way higher than we ended 2024, but they're down on the week. And even bigger losses in the mining stocks. The GDX and the GDXJ were both down over 11% on the week, including small losses today, even with the rise in gold and silver. So the question is, why, right? Isn't war supposed to be good for gold and silver? Why didn't people buy gold and silver? After all, oil soared on the week, up about 35%. We closed around $91 a barrel. This is the biggest weekly gain in oil, I think, since the mid-1980s.
Markets love to tell a simple story, but this week the numbers quietly broke the narrative. As Peter Schiff points out here, gold dropped about 3% and silver roughly 5%, even while oil exploded 35% to around $91 a barrel, the biggest weekly jump since the mid-1980s. Normally, geopolitical shocks push investors towards safe havens, yet mining stocks like GDX and GDXJ fell more than 11%, which hints at institutional traders de-risking rather than retail panic. That divergence often shows up when hedge funds unwind leverage quickly rather than when fundamentals truly change. Next, Peter Schiff discusses why the war headline may have triggered profit-taking instead of a sustained gold rally.
And in fact, on the year now, oil is up 65% because we were already rising before the war. Now, some of that rise was probably in anticipation of the war. We were already building a war premium into the oil price before the war broke out. And that, I think, is the main reason that gold and silver sold off. I think it was a buy the rumor, sell the fact, because I think that there was some speculative buying in gold and silver in anticipation of a war with Iran. And the Trump administration had made it pretty clear that this was going to happen. We just didn't know exactly when. I mean, we knew it would happen over a weekend. We just didn't know which weekend. You know, Trump likes to move when the markets are closed. But we had already moved a lot of our ships and personnel into the region, so it was pretty clear. And gold was going up. I mean, gold had, gotten pretty high at the end of last week. And so when the bombs started to fall on Saturday and gold initially opened for trading on Sunday night, it got near 5,500. That was around the high. But because gold couldn't really break to new highs, I think the people who had bought in anticipation of the war sold on the news. You know, you buy, what is it? Another expression, the trumpets, and you sell on the cannons or whatever.
The market often prices in the event long before the headline ever arrives. As Peter Schiff points out here, oil had already surged 65% for the year before the war even began, meaning traders were quietly building a geopolitical risk premium weeks earlier. When gold briefly touched around $5,500 as markets reopened Sunday night, the move stalled, a classic signal that speculative positioning had already peaked. Institutional desks frequently unwind trades once the expected catalyst becomes official, turning fear-driven momentum into a profit-taking event. For investors, this pattern matters because it shows how narrative timing can override fundamentals. Next, Peter Schiff unravels how that same positioning spilled into gold mining stocks.
But we sold on the actual war. The traders took profits, and gold and silver went down. And of course, gold and silver stocks that may have also been bought for the same reason. People bought those stocks thinking, hey, if we have war with Iran, that's good for gold. I'm going to buy some gold mining stocks. And then when gold went down, when the war broke out, a lot of those traders sold their gold stocks, and that caused that big drop. And if you recall, this has been how the mining stocks have acted for the entire bull market, because the investors have got one foot out the door. They've always been skeptical of the rally. They think gold's going to collapse. So they overreact to every down move. And you can see that overreaction most profoundly in the gold and silver mining stocks. But I think this is a head fake week. I think that the war is going to be very good for gold and silver. And ultimately, the market is wrong not to recognize that now and buying these metals. But I think by next week, we should be, off to the races. I think you're going to see a big recovery in the stocks. I mean, part of the reason, too, now is I think the world is overly optimistic, particularly Americans, on this war. I think people still think it's going to be short and sweet, a quick, mission accomplished, and it's not going to be that disruptive.
Mining stocks often reveal investor psychology faster than the metals themselves. As Peter Schiff points out here, when gold slipped after the war headlines, traders dumped mining equities almost immediately, pushing sector ETFs down more than 11% in a single week. That reaction reflects a deeper issue. Institutional investors still treat gold rallies as temporary trades rather than long-term macro shifts. Historically, in past cycles like 2005 to 2011, miners lag early before suddenly outperforming once conviction returns. If this conflict lasts longer than markets expect, those same investors may rush back into the sector just as quickly as they exited. Next, Peter Schiff discusses why war financing, not war itself, could drive the next gold surge.
And the reason the war is bullish for gold is not because of the war itself, but because of the way we pay for it. The way we're going to pay for this war is by creating more inflation. And that's what's bullish for gold. We are going to run bigger deficits because of the war. Now, we were going to run bigger deficits anyway because of the weakness in the economy and because of rising rates as a lot of our low-yielding debt matures and it has to be rolled over at the market. So we were already on an upward trajectory. But the war is going to weaken the economy. It's going to lead to higher long-term interest rates. And by the way, bond yields rose about 14 basis points. The yield on a 10-year Treasury closed the week at about 4.13. It was just below 4% at the end of last week. So people, maybe they bought the dollar, but they didn't buy Treasuries. They sold U.S. Treasuries. So Bitcoin, to me, at 68,000, it's just going lower. This is the same reaction that we had in the stock market as we had as Bitcoin. There wasn't nearly enough pessimism. But getting back, what I was saying about the deficits, And the war itself is going to be expensive. And you know that. Just look at these defense stocks, right? They were the strongest stocks.
The real market signal isn't the war headline, it's how governments pay for it. As Peter Schiff points out here, the key shift is fiscal. Rising deficits layered on top of already expensive debt refinancing as trillions in low-rate treasury bonds roll over at higher yields. The 10-year treasury jumping roughly 14 basis points to around 4.13%, while investors sell bonds instead of buying them, is a warning sign many headlines ignore. Defense stocks rallying while bond markets weaken suggests capital is positioning for higher government spending and inflation pressure. That mix historically pushes real assets higher while squeezing traditional portfolios. Next, Peter Schiff talks about how this spending cycle could reshape the entire gold outlook.
Plus the energy stocks. That's where I made money this week. You know, my second biggest personal position in my portfolio is energy. And so my oil stocks did well, and I think they're going to do, better, get, more in the weeks to come. But it wasn't enough to offset the losses I had in my mining stocks, because that's overwhelmingly my number one position. But I'm not concerned about that. In fact, if we're lucky enough to get a bigger drop, I might have to buy more, but I doubt it. I don't think we're going much lower. And I would recommend that people watching the video just buy them on Monday, the first chance you get before reality sets in and people realize just how high the gold and silver price are going to go. And by the way, I would buy again over the weekend. Right? Didn't work last weekend. Now, it looked like it worked. The people who followed my advice last week and bought gold on Friday and Saturday morning probably thought they were geniuses, right, when they saw the war and gold started to run. But then it turned around. But this week could be the mirror image of that. So I would go to Schiff Gold and I would buy this weekend. I would not wait for Sunday night again.
Sometimes the most revealing signal in markets is where experienced investors are quietly placing their own money. As Peter Schiff points out here, his portfolio gains came from energy stocks this week, while his much larger position in mining shares took the hit, showing how sector rotation can temporarily mask the bigger macro story. Oil companies benefited from the same geopolitical shock that briefly pressured precious metals, highlighting how capital often flows first into energy before returning to inflation hedges like gold. For investors, the takeaway is timing and patience rather than chasing headlines. Next, Peter Schiff discusses why he believes gold could accelerate sharply from here.
To me, we could be at $6,000 gold very quickly, and silver could be back above $100 an ounce very quickly, as oil prices are going to be over $100 a barrel. But the other thing that's going to be driving this, I forgot, on the cost of the war. Donald Trump has already made it clear. Not only are we going to pay for this war. I mentioned the defense stocks going up. Why are they going up? Because they're going to get a lot of orders. Because we're blowing up all the stuff that we bought from them in the past, and now we have to buy new stuff so we can blow that up. So the military-industrial complex is going to make a ton of money off of this war. They always do. And that means the U.S. government is going to be out a ton of money. We're going to have to pay for the war. Where are we going to get the money? Trump is not going to say, we got to raise taxes. We need a wartime tax to pay for the war. Of course not. They're just going to run bigger deficits. Where's the money going to come from? The Fed. Fed's going to crank up the presses. That's why wars are bullish for gold, because they're financed with inflation. Because the politicians don't want the public to have to pay for the war.
The real catalyst behind big commodity moves is rarely the conflict itself. It's the financing behind it. As Peter Schiff points out here, wars historically push governments into larger deficits because raising taxes during conflict is politically toxic, leaving central banks to quietly absorb the cost. That dynamic expands money supply, while production capacity often shrinks, which is why energy prices and defense stocks typically surge first. Investors saw a similar pattern during the Iraq War era in the early 2000s, when gold climbed from roughly $300 to over $1,000 within a decade. Understanding the fiscal mechanics matters far more than reacting to headlines. Next, Peter Schiff unravels why rebuilding costs could magnify the inflation impact.
Then they really won't support it. They want them to think they get the war for free. But it's going to cause more inflation. But not only do we have to pay to destroy Iran, we now have to pay to rebuild it. Donald Trump has now committed that we're going to fight until we get unconditional surrender from Iran so that we can come in there and take over the country. And then we're going to rebuild it. Make Iran great again. And, I mean, at one point it was great, I guess, a long time ago. But now we got to make Iran great again. What's that going to cost us? How much money are we going to spend building Iran? I mean, I guess we're going to build it better than it was. Okay. So how much is that going to cost? Where's that money going to come from? I mean, we're talking about hundreds of billions, probably in excess of $1 trillion to destroy and rebuild Iran. So this is very inflationary. So it's bullish for gold, it's bullish for silver, it is bearish for the dollar. But the other thing that's bearish is the economy. The economy was already weakening, and we got more data today to prove that. And this may be one of the reasons, again, for this war.
Governments rarely discuss the second bill that comes after every conflict: reconstruction. As Peter Schiff points out here, destroying infrastructure is only half the economic story, because rebuilding entire regions can cost hundreds of billions or even trillions of dollars over time. Those expenses rarely appear up front in official projections, yet historically they expand government debt dramatically, as seen after wars in Iraq and Afghanistan, where total costs exceeded early estimates by several multiples. For investors, that means persistent fiscal pressure, currency risk, and long-term inflation exposure that can quietly reshape portfolios. Next, Peter Schiff talks about the political incentives that sometimes drive conflicts themselves.
I mentioned at the other podcast, kind of like Wag the Dog, that movie. But it's a distraction. It's an excuse. Trump knows that. He even thought that Obama might have used a war over Iran, started a war with Iran, because he was in trouble politically and he needed a distraction. He needed something. And obviously Trump needed something, not just because of the Epstein files, but the economy was weakening. He had a big loss in the Supreme Court with the tariffs. So everything was kind of falling apart. And this whole idea that we had this hot economy was about to blow up because the numbers don't bear it out. The economy was weakening. Inflation was strengthening before we launched a war against Iran. But now, Donald Trump will be able to blame all this bad stuff that would have happened anyway. Yeah, now it's going to happen even worse, but it was going to happen and it was going to be bad. But now Trump can say, well, it's because of the war. Like, everything was great, but unfortunately my back was to a wall because Iran was about to attack us. I had no choice, so we had to preempt, we had to go first, and now we're stuck in this war.
Political timing and economic stress often collide in ways markets prefer not to examine too closely. As Peter Schiff points out here, the concern isn't just the war itself, but the possibility that weakening economic data was already pointing toward trouble before the conflict began. When growth slows while inflation rises, policymakers face a narrative problem, and wars can sometimes shift public attention away from domestic weaknesses. Investors have seen similar patterns before, where geopolitical crises conveniently overlap with fragile economic cycles. That doesn't prove intent, but it does explain why markets often misread the bigger picture. Next, Peter Schiff discusses how this narrative shift could reshape expectations for the economy and markets.
This noble war that we have to fight, and so the cost of this freedom is going to be, well, we're going to have a recession, we're going to have some higher inflation, but it's going to be worth it in the long run. Then everything is going to be great, right? It's just another excuse that could be a scapegoat for problems.
Deficits rarely shrink after crises. They compound, quietly reshaping the entire financial landscape. As Peter Schiff points out here, the concern isn't just one administration's spending, but a long-term pattern where each presidency inherits massive debt and then expands it further. The US national debt has already crossed $34 trillion, and historically, both parties have accelerated borrowing during economic slowdowns or geopolitical conflicts. For investors, that trajectory matters because persistent deficits tend to pressure currencies and eventually redirect capital toward real assets like commodities and metals.